When you start to see the foundational instruments of finance, like government bonds, moving sharply and universally, it's not noise, it's a signal, it's the market whispering something very loud. A major shift is underway. And if you're not paying attention, you're going to be on the wrong side of the future. For the past 4 decades, we've lived through one of the most extraordinary economic environments in human history, a time where interest rates trended down almost continuously, asset prices rose almost in a straight line, and monetary policy became the primary tool to manage both economic shocks and market behavior. But now that period is over. We are entering a completely different environment. The signs are everywhere, and they're impossible to ignore. What we're seeing today in the form of rapidly rising bond yields is not simply a market adjustment. It's the beginning of a profound shift, a shift from the world of cheap and abundant credit to one where money has a real cost again, and that's a game changer for everything. For 40 years, the dominant force in global markets was declining interest rates driven by central banks loosening monetary policy. That era started in the early 1980s when inflation was finally being tamed after a decade of volatility. From that point onward, central banks adopted a policy framework that encouraged consistent monetary easing whenever growth faltered or markets wobbled. It worked because inflation remained subdued for most of that time, giving central banks room to act without fear of destabilizing price levels. Rates were cut, liquidity was injected, and debt became the lubricant that fueled global growth. This approach reached its extreme after the 2008 financial crisis. In response to the worst collapse in modern banking history, policymakers slashed interest rates to zero, or below zero in some countries, and began engaging in large-scale asset purchases known as quantitative easing. These tools weren't temporary fixes. They became permanent features of economic management, and they gave rise to a market psychology that believed interest rates would stay low forever, that central banks would always provide liquidity, and that asset prices would always be supported. But that psychology is breaking down now, and it's breaking down fast. What's changed is that inflation, the silent threat that was dormant for so long, has returned. But it hasn't returned in the same way it did in the past. This time, it's structural, not just cyclical. It's driven by factors that monetary policy can't easily fix. Deglobalization is making production more expensive. Labor markets are tightening because of demographic shifts. Energy costs are rising due to supply chain constraints and the complexity of transitioning to new sources. All of this means inflation isn't going away with a few rate hikes, and because of that, the old playbook is no longer usable. Central banks now face a dilemma. They must tighten monetary policy aggressively to prevent inflation from becoming entrenched. But that tightening comes with significant costs: lower growth, rising debt burdens, and higher unemployment risks. Yet they have no choice, because letting inflation run wild would be an even bigger disaster. So they are raising rates at the fastest pace in decades. They're shrinking their balance sheets. They're sending a clear message to markets. The era of easy money is over, and that's what's being priced into bond yields today. Yields are rising because markets are recalibrating. They're adjusting to the reality that capital is no longer free, that interest rates are not going back to zero, that central banks will no longer be the buyer of last resort for every asset class. That realization changes everything: how companies borrow, how governments fund deficits, how investors assess risk, and how economies grow. The impact is not just economic, it's psychological. We are witnessing the end of a multi-decade belief system, the belief that central banks could always save the day, that debt didn't matter, that liquidity would always be there. Those assumptions are breaking down in real time, and when belief systems break, markets don't just correct, they reset. This reset is painful, but it's also necessary. For too long, we've lived in an artificially supported world. Markets were distorted. Risk-taking was mispriced. Capital allocation was inefficient. Tightening monetary policy is forcing a return to fundamentals. It's making us face reality again. And while that may be uncomfortable, it's ultimately healthy. The key now is to understand that we're not in a temporary dislocation. We are in a structural transformation. The rise in bond yields is not just about inflation. It's about the entire architecture of global finance shifting under our feet. What comes next will look very different from what came before, and those who don't adapt to this new environment will find themselves caught off guard, not just once, but again and again. This is not the end, it's the beginning of something new, something more disciplined, more volatile, but also more grounded in economic truth, and that's where opportunity lies. If you know where to look, in markets, everything ultimately comes down to supply and demand, and when there's a structural imbalance between the two, especially in something as foundational as sovereign debt, you can expect significant shifts in pricing. That's exactly what's playing out in the bond markets today. Yields aren't rising randomly or irrationally. They're rising because the balance that held the bond market together for decades is breaking down. The sources of demand that used to absorb enormous amounts of government debt are pulling back, just as the supply of debt is exploding. That's a recipe for yields to move upward, and to do so persistently. For years, the bond market functioned under the assumption that demand for government bonds, especially U.S. Treasuries, was almost infinite. Central banks, sovereign wealth funds, pension funds, and foreign governments were all eager buyers. They were willing to hold the instruments not just for return, but for safety, for regulatory reasons, for liquidity. That dependable demand helped keep yields suppressed even as debt levels ballooned. In fact, the more governments borrowed, the more buyers seemed to appear, because they were operating in a world where inflation was low, risk was misunderstood, and central banks stood behind the market as a stabilizing force. But now, the landscape is changing rapidly. On the demand side, traditional buyers are stepping back. Foreign central banks, especially in places like China and Japan, are no longer increasing their holdings at the same pace. In some cases, they're actively reducing exposure. They have their own domestic pressures to manage, their own currency issues, and their own interest rate dynamics. Holding vast amounts of U.S. Treasuries or other developed market bonds is becoming less appealing. Add to that the growing political tensions and the weaponization of finance, sanctions, asset freezes, currency interventions, and it's not hard to see why some nations are starting to view holding foreign bonds as a vulnerability, not a strength. At the same time, central banks themselves, those who flooded the system with liquidity during years of quantitative easing, are reversing course. They're not just raising rates, they're shrinking their balance sheets. That means they're no longer buyers of government bonds. In fact, they're now competing with the private sector to sell. That flips the dynamic completely. What was once a backstop has become a source of additional supply. Markets are now being asked to absorb trillions of dollars in debt issuance without the help of the very institutions that previously absorbed the slack. Meanwhile, governments are showing no signs of slowing down their borrowing. Fiscal deficits remain enormous, and in many countries they're growing. Entitlements, infrastructure, defense spending. These pressures aren't cyclical, they're structural, and the political will to rein in spending simply isn't there. In fact, the incentive is often to do the opposite: spend more, stimulate more, promise more. That creates a relentless flow of new bond issuance coming to market. And without a matching rise in demand, prices have to fall. And when bond prices fall, yields rise. It's simple arithmetic, but with enormous consequences. The scale of this imbalance is difficult for most people to grasp because it's not just about one country or one economic cycle. It's global. Europe is issuing more debt. Japan is reaching the limits of its yield curve control. Emerging markets are under pressure to finance their deficits in a rising rate environment. There is a global glut of sovereign debt and fewer buyers willing to step up at current yield levels. That means the market will keep testing higher yields until equilibrium is restored. But that equilibrium point is likely much higher than what we've grown used to over the past 20 years, and we haven't even factored in private sector behavior. As rates rise, the competition for capital intensifies. Investors begin to demand higher yields not just from government bonds, but from all forms of credit. Corporate debt, mortgage, backed securities, municipal bonds. They all have to reprice, capital becomes more expensive, refinancing becomes more difficult, risk premiums expand, the cost of debt servicing rises across the board. This has feedback effects on consumption, investment, and ultimately growth. None of this should be surprising. It's what happens when a system runs on cheap money for too long. Eventually, the cracks form. The assumptions that held everything together, like the idea that demand for debt will always be there, start to break. And the result is what we're seeing now: rising yields, market volatility, and a fundamental rethink of risk. This isn't a short-term dislocation, it's a long-term structural adjustment. The imbalance between supply and demand in the bond markets isn't going away overnight. It's part of a broader transformation, a shift from a world defined by abundance and support to one where scarcity and discipline return. And as painful as that shift may be, it's the correction the system needs to function sustainably again. When you look at markets, especially the bond markets, what you're really seeing is a reflection of perceived risk. Every yield, every spread, every price movement is the collective judgment of millions of participants trying to quantify uncertainty. And right now, across the world, that uncertainty is growing. It's not just economic, it's geopolitical, social, technological. We are living through a period of structural instability, and as the world becomes more fragile, investors are demanding higher compensation for taking on risk. That's what a rising risk premium is. It's the price of uncertainty going up. For a long time, the world appeared unusually stable. There was a belief that globalization would continue indefinitely, that trade and capital would flow freely, that international cooperation would prevail over conflict. That belief reduced the perceived risk in markets. Investors were comfortable lending money at low returns because they believed the world was predictable, inflation was under control, and central banks had everything in hand. That perception held down risk premiums across the board, whether in equities, real estate, or government bonds. But now that sense of stability is breaking apart. We're seeing a world where the old assumptions no longer hold. Alliances are shifting. Wars are breaking out. Economic blocs are fragmenting. Trust between nations is deteriorating. And internally, countries are facing rising levels of political polarization, social tension, and institutional dysfunction. This is not an environment where investors feel safe. It's an environment where they demand to be compensated more just to hold what was once considered risk-free debt. Start with geopolitics, the rules-based international order that was established after World War II is being tested like never before. Whether it's the reemergence of great power competition, the weaponization of financial systems, or military conflicts in strategic regions, these factors inject new risks into markets. Bonds issued by governments are no longer seen as universally safe just because of their credit ratings. Investors are asking, what if the rules change? What if sanctions are imposed? What if assets are frozen? Those questions didn't exist at this scale before. Now they do, and they're influencing how capital moves. Then there's fiscal risk. Many governments are operating with ballooning deficits and mounting debt loads, and in some cases, there's no credible path toward stabilization. When investors see large deficits with no political appetite for reform, they worry not just about inflation, but about fiscal sustainability. They start pricing in the possibility that governments may resort to financial repression, currency debasement, or unconventional measures to manage their obligations. That adds a layer of uncertainty that didn't exist when debt levels were more modest and policy was more disciplined. In response, yields must rise to account for the increased credit and policy risk. Add to that the macroeconomic landscape. Inflation, once thought to be a cyclical blip, is showing signs of staying more persistent. The drivers are structural, tight labor markets, disrupted supply chains, climate-driven energy transitions, and the unraveling of hyper-efficient global logistics networks. All of these forces make inflation more difficult to forecast and control, and when inflation is uncertain, the real return of a bond becomes uncertain too. So investors build in a cushion. That cushion is the risk premium, but it doesn't stop there. Technological disruption is also a form of risk. As artificial intelligence, automation, and digital currencies reshape labor markets, financial systems, and social contracts, the range of possible outcomes widens. The pace of change is accelerating, but regulation and governance aren't keeping up. That gap breeds instability. It makes the future harder to predict. And when the future is harder to predict, investors get nervous. They don't just demand a return. They demand a buffer against what they can't see coming. Markets are forward, looking. They don't wait for uncertainty to become a crisis before they reprice. They sense it early. What we're witnessing now is that repricing. It's not panic. It's rational. It's a reassessment of reality. Investors are saying the world is riskier than it was. Therefore, the cost of capital must be higher. That's what rising yields and widening spreads represent. A world where trust costs more, where safety is no longer cheap, and where risk cannot be ignored or offloaded. This adjustment is necessary. For too long, capital was mispriced because risk was misjudged. The illusion of stability led to distortions, overleveraging, underpricing of downside scenarios, excessive risk-taking. Now we're going back to a world where risk is properly acknowledged, priced in, and managed. It's more volatile, yes, but it's also more honest. And that honesty is what allows systems to find their balance again. You can't wish away uncertainty. You have to adapt to it. And the way markets adapt is through price. The higher risk premium we're seeing now isn't a problem. It's a signal that the world is waking up to the reality that things are changing fast and fundamentally. Inflation is not just about numbers on a chart or movements in consumer prices. It's about psychology. It's about what people expect to happen in the future and how they act on those expectations today. That's what makes inflation so powerful and at the same time so dangerous. Once expectations get embedded into decision-making by businesses, workers, investors, and policymakers, it becomes extremely difficult to bring inflation down without significant consequences. That's exactly where we are now. Inflation expectations, even after aggressive rate hikes and tighter financial conditions, have proven to be remarkably resilient, and that resilience is reshaping the entire economic landscape. For years, central banks operated with the confidence that inflation expectations were anchored. That meant they believed the public trusted them to manage inflation over the long run. This belief gave policymakers enormous flexibility. They could run the economy hot, provide stimulus during downturns, and expand balance sheets without triggering inflationary panic. And it worked for a while, largely because global deflationary forces were strong. Aging populations, Technological deflation, outsourcing, and cheap energy kept prices in check. But that dynamic has shifted. The old anchors aren't holding like they used to. People are starting to question whether inflation is truly under control, and that change in sentiment is quietly but powerfully altering behavior. You see it in the way businesses price their goods. They're quicker now to raise prices in anticipation of higher input costs rather than waiting to be squeezed. They're embedding inflation buffers into their contracts, into their supplier relationships, into their capital expenditure plans. That's not just reacting to past inflation. That's acting on expected inflation. And when that happens across thousands of companies, you get a self-reinforcing loop. Higher expected inflation leads to higher actual inflation because everyone's behaving like it's coming. The labor market tells a similar story. Workers are asking for larger wage increases, not just to catch up with lost purchasing power, but to stay ahead of anticipated cost of living increases. They've seen what inflation can do to their real incomes, and they're not waiting around to be blindsided. Again, wage negotiations are now incorporating future inflation assumptions in a way they haven't in decades. And when wages rise on the basis of expectations, it feeds back into costs, into pricing, and into the very inflation metrics that central banks are trying to suppress. What makes this so difficult is that expectations are sticky. Once people believe inflation is going to persist, they don't change their minds easily. You can raise rates, you can shrink the balance sheet, but reversing a psychological shift takes time and trust is eroding. The public no longer views central banks as infallible. After years of overpromising and underdelivering, especially around the idea that inflation was transitory, confidence has been shaken. And when confidence in monetary policy weakens, expectations become unmoored. People start to hedge in their own ways. They move capital differently. They change how they consume, how they save, how they borrow. All of that changes the flow of money through the system. This isn't just a problem for the present. It's a long-term challenge because it fundamentally alters the equilibrium around which economies function. Decades, policymakers operated under the assumption that inflation was predictable and controllable. That assumption allowed them to keep rates lower for longer, to run larger deficits, to stretch the boundaries of stimulus. But now that expectations are more volatile, that flexibility is gone. Policy has to be more cautious, more preemptive, more disciplined. Otherwise, the credibility gap will widen, and expectations will drift further from targets. What markets are seeing, and why bond yields are rising, is that bringing inflation expectations back to target is going to take more than rhetoric. It's going to require real, sustained tightening, not just rate hikes, but a willingness to tolerate economic pain, a willingness to let unemployment rise, a willingness to let over-leveraged sectors correct, and most importantly, a willingness to signal that the era of financial repression is over. That's what it takes to rebuild credibility and realign expectations. But this process doesn't happen overnight. The resilience of inflation expectations means the path back to price stability is longer, bumpier, and more uncertain than most people are prepared for. It means policy will remain tight for longer. It means markets will remain volatile. And it means that we're not going back to the environment of zero rates and endless liquidity. That era was built on the assumption that inflation was dead. Now that assumption is gone. Inflation expectations are the invisible driver of economic behavior. When they shift, everything else follows, and right now they're not falling in line. They're holding firm, and until that changes, everything else, yields, rates, capital flows, asset prices, will continue to reflect that stubborn, resilient belief that inflation isn't going away anytime soon. Most people think in short-term cycles, booms and busts, expansions and contractions. but the most important forces shaping the economy play out over much longer time horizons. They move slowly, almost imperceptibly, until suddenly they don't. That's what defines a debt supercycle. It's the decades-long process of accumulating debt, household, corporate, and government, fueled by ever looser monetary policy and expanding credit availability. And now, that cycle, which has underpinned global growth for the better part of the last 70 years, is reaching its limits. What we're witnessing isn't just another downturn or credit correction. It's the end of the debt supercycle. For decades, economic growth was increasingly built on borrowing rather than productivity. Each downturn was met with lower interest rates, easier credit, and more public spending, allowing households and businesses to borrow more to sustain consumption and investment. This created the illusion of stable growth, but underneath, debt burdens were quietly compounding. As long as interest rates kept falling, the cost of servicing that debt remained manageable, and so the cycle was able to continue. But there's a finite amount of room to lower interest rates. Once you hit zero or below, it becomes clear that you've been borrowing from the future. Eventually, the future arrives. Now we're in a world where debt levels are historically high, and the tools we've relied on to manage those levels, like monetary easing, have lost their effectiveness. Rates are rising, not falling. Central banks are no longer buyers of last resort for sovereign bonds. Fiscal authorities are stretched thin, and inflation is no longer dormant. In this environment, trying to grow out of debt the way we've done in the past simply doesn't work anymore. That's the hallmark of the end of the supercycle, when the old solutions stop working and the consequences of decades of accumulation come due. We've already seen this play out in multiple ways. Sovereign debt levels in major economies have reached proportions that would have once been considered unsustainable. The only reason they seemed manageable until now was because rates were artificially suppressed by central banks. Now that the cost of borrowing is rising again, that sustainability is being called into question. Investors are looking more closely at fiscal trajectories, at political stability, at demographic trends. They're no longer willing to lend at the same terms they used to, because they're finally pricing in the risk that the system is over-leveraged and underprepared for what comes next. You can see the pressure building in financial markets. Long-term yields are rising not because of strong growth expectations, but because of deteriorating trust. Trust in governments to rein in spending, trust in central banks to manage inflation without triggering recession, trust in the currency itself to retain value over time. Once that trust erodes, it doesn't come back quickly. It has to be rebuilt, and that process often involves painful corrections, defaults, restructurings, inflationary episodes, or some combination of all three. The end of a debt supercycle is marked not just by economic pain, but by political and social instability. When the burden of debt can no longer be rolled forward, societies are forced to make hard choices. Who pays? How much austerity is tolerable? What promises can no longer be kept? These questions don't get answered by technocrats. They get answered through conflict between generations, between classes, between political ideologies. That's why the end of the cycle is so destabilizing. It doesn't just unwind excesses. It reshapes institutions, redistributes power, and forces a rethinking of what's sustainable. What makes this moment so pivotal is that it's happening globally. It's not just one country that's overleveraged. It's not just one central bank that's out of ammo. The entire developed world built its post-war prosperity on the same model: cheap credit, rising asset prices, growing entitlements, and central bank backstops. Now, all those pillars are cracking at once, and there's no clear replacement. We're in a transitional period where the future system has not yet emerged, and the old one is no longer viable. That creates a vacuum, one that will be filled, but not without volatility and risk. This isn't about doom. It's about recognizing the shift. The end of the debt supercycle doesn't mean the end of progress, but it does mean that progress will have to come from different sources: real productivity gains, fiscal discipline, institutional reform. We can no longer rely on leverage to paper over structural weaknesses. That era is over. The next era will be defined by how we confront the consequences of that reality. And those who understand the magnitude of this shift, who can step back from the noise and see the long arc, will be best positioned to adapt and to lead in a very different world. The world is reshaping itself. The forces that once drove prosperity, cheap debt, globalization, easy policy, are fading. In their place is a new environment, more volatile, more fragile, and more real. Yields are rising not because of panic, but because truth is returning to markets. And truth, while often uncomfortable, is always the foundation of lasting progress. So ask yourself not just what's happening, but what it's telling you, because in this new world, only those who adapt will thrive.